Phil Blackman, current president of Engineers and Architects of Hawaii, an organization founded in 1902. We have community outreach in these Olelo broadcasts, a premiere each second Wednesday of the month on channel 53 at 6 p.m. And then followed up for the rest of that month, the Sunday showings at 1 p.m., same channel. So we encourage too, when you've watched the show and have some comments or ideas, to go ahead and email us with that. Each month we attempt to find one to select to receive an award of $50 for that contribution. Our program for this month features a loan officer for American Savings Bank who has insight into the current market conditions and to the mechanisms and kinds and styles of mortgages that are available. And I think you'll find this an excellent shortcut to a perspective on options you have as an individual that wants to borrow money or a seller that wants to understand the process a buyer is going to have to go through to qualify.
But those are some of the special programs that are out there. And if you guys do have any questions, I would like to open it up to you guys. So I'll stop the sharing. And if you guys want to unmute and ask any questions about what I talked about, let me know.
I did have a couple of questions on your earlier slide on brokers, where you talked about the differences between banks, brokers, and lenders. I think there was a third item. I don't remember.
Oh, correspondent lenders?
Correspondent lenders, yeah. So, and then you mentioned wholesaling. So does a broker essentially make money on reselling the loan to a lender? Like, someone comes to a broker and the broker says, I'll get it, from this lender at X amount, and then he'll buy it from the lender at a lower price. So he's wholesaling from the lender? Is that how it works? Kind of?
I'll give you an example of what a wholesale lender is. So Bank of Hawaii does have their own sales team, but they also have what's called a wholesale division. So a wholesale division basically says, here's our rates, and brokers can take their loan to Bank of Hawaii and basically get a Bank of Hawaii mortgage product.
Right, and then they sell it to a higher price, or it's a slightly higher for the So the broker will only receive the compensation from closing the loan with Bank of Hawaii. And then Bank of Hawaii basically is the one, if they really wanted to sell that loan, they could sell that and earn a premium, but that doesn't go to the broker at all. Oh, I see. So the broker only makes money on the
actual transaction. Yeah.
On just a single transaction. So, okay, gotcha.
Yeah. So a lot of times, a lot of people wonder, like, how do brokers get paid? Or even for me, I get paid just on volume. If you ever try to shop a rate, I show people like 5 different rates to choose from. And there's what's called points. A lot of people think that points is how we get paid and brokers get paid. That's not necessarily how it works. Basically, you can do what's called a 0-point loan. That means you're not paying any extra fees to get, of that rate, but that rate's going to be higher than basically getting like let's say, for example, at 3.5%, it's 0 points. So you're not going to pay extra to get 3.5% on a 30-year fix. But if you go, Manny, I really want a lower rate, you can go to 3% and pay a 1/4 point. I'm sorry, like 2 points. But 2 points represents 2%. So if, let's say you're talking about $1 million mortgage, 2% is going to be 20 grand. But you're paying that fee to the bank, like for American Savings Bank, for example, and they're going to give you the lower interest rate for that upfront cost. But I get paid regardless if it's a 0 point or 2 points. I just get paid on volume. And brokers are very similar to that too.
Yeah. And you also mentioned private lenders. Now, would this be equivalent to someone who, an investor who, basically loans money to help close a deal for something to another investor, like private money or hard money? So higher interest rate, is that basically what you're talking about with private lenders?
Yeah, I mean, I would look at it as like a loan shark. So so I have some friends that do hard money, and they'll charge rates between 8 to like 12% with a couple points. But it's a very short-term loan because people are unfortunately in a situation where they need to close the loan, and the hard money will come in and do it for them. But a lot of times they look at a lot of skin in the game if you have a lot of equity, but let's say you don't have income to qualify. So they'll do those loans, but the expectation is that you're going to pay them off in a few years once your income meets a certain level. A lot of builders or contractors use that if they don't have the capital to buy a property, so they use hard money. So private lending also just means that it's not in the secondary market.
Yeah.
So there is some other lenders that don't charge crazy rates, but it is higher than what you would normally get if you can qualify for financing.
Yeah, I mean, investors will use that a lot, especially if they get into a deal where they like it, and but they don't want to use the cash, or they don't have the extra cash to put in the down payment, and sometimes, you know, you can get seller financing too from the owner, but they may want some money up front, part of that, and then that's where you can say, okay, I'll give you, a 20% down, and then we can do the financing. You can finance it for me.
Yep.
And that down payment could come from from a hard money lender.
Yeah, that is true.
Finance. So have you seen that? Is that very common from what
I have a few friends that are very involved in that marketplace.
Okay.
If I have a client that really needs to do something, I can refer it to them. The hard thing is, it's just you really got to make sure they understand what they're getting themselves into, because as much as I like to refer to other people, if I can't do it, I don't want to be responsible if that other party does something that is, that may not seem right, because hard money can be a little bit sketchy sometimes.
It can be, but it can also give you a lot of opportunities too.
Yeah, absolutely. For the right person that understands what they're getting themselves into. So definitely, for sure, it can be beneficial, but you have to have a better understanding of the loan product for sure.
Yeah. Thank you.
Yeah, of course. Any other questions?
Maybe I've done the math wrong, but it seems to me if I wanted to buy the house down the street that was $1 million, and I was able to get a 3% loan, I would be paying annually $30,000. How long?
In interest? Yeah, correct. Around there.
Yeah, that's right.
How long would it take me to pay $1 million at that rate? 30 years? Would it? Doesn't seem right.
Well, if you do a 30-year fix, you're going to take 30 years. Yeah, that's correct.
That's a lot of money over time.
So $1 million loan at 3%, you'll in a 30-year loan, is how it works. It seems pretty reasonable.
Well, that's going to be about a $4,200 principal and interest payment. So tack on taxes and insurance, you might be looking at somewhere close to $5,000. But as long as you can afford that, then yeah, it's not a bad deal. But it's all relative. If you ask somebody else, $5,000 a month could be what their paycheck is.
Well, $30,000 a year doesn't divide up to $5,000 a month.
Well, $30,000 is just the interest. When you do a 30-year payment, you got to factor in the principal that you'll be paying to pay down that loan.
Oh, and that's one of the other numbers you used. I must have missed that.
Well, you said how much interest you'd be paying on $1 million, and 3%, $1 million bucks, you'd be paying about $30,000 in interest.
Yeah.
Then you got to basically take that $1 million and start to pay it down over 30 years. There's some principal in there, so that's about $4,200 is what it comes out to on an amortization payment.
Yeah. Yeah. These it looks nice on paper, but you're basically going to end up paying to more than $2 million over the course of the loan if you don't change it. You're basically doubling what you're paying, so it's significant. So for $1 million loan, you're paying $2 million total.
At 3%, you're paying probably about 600,000 if you paid it for the whole 30 years.
Oh, really? Is it?
Yeah,
Oh,
it's a
maybe
little
I'm
bit
thinking
less.
like closer to 5%. Yeah.
Yeah. Now, if you pay 3%, 30,000, and you times that by 30 years, you're going to be paying interest down over time. So you'll probably pay around 500 to 600,000 at 3%.
Okay. Yeah. So it's not as bad, but it's still 50% of the value of the home at 3%.
Yeah. Yeah.
Yeah. That's
but in 30 years, your $1 million house maybe worth $5 million.
Probably, unless we get a tsunami and wipes out Waikiki, and then everything is zero.
Well, at that point, we have bigger issues than your property values. Yeah. Any other questions?
Well, going back to the slow interest rate, it seems to me some time ago, might have been 10 or 20 years ago, all of a sudden, the government was bailing out banks. And the best I could tell was the banks were giving loans to people way more than they could ever pay in their lifetime, I guess. And am I right on that? And is that, why would that not happen today with these low interest rates?
So it's a good question, but the banks during the subprime crisis, or like the mortgage market meltdown. So I'm a accountant by trade, and when they started to roll out a lot of these products, I always was like, why would we ever provide capital to somebody that doesn't support their income, has bad credit, and has no skin in the game? So a lot of the clients that I originated loans for qualified, because I would tell people, I go, you don't have the income to qualify for this. Are you sure you want to do this? So a lot of my clients personally, I feel really good that they didn't really get into a lot of trouble. But yes, there was a lot of products out there that you could basically get a loan with no money down, just have decent credit and don't have to support income. Today, though, the new financial rules is we have to basically show that without a doubt, you qualify for the financing, which means that we have to verify income, we have to verify assets, and we will only do a loan today if you actually can show that. So back in the day, 13 years ago, in 2008, 2009, around there, that wasn't there. And that was one of the huge reasons why there was this huge rise in prices, because everyone could buy a property, but people didn't really qualify. Now today, people are qualified. So where rates are low, the challenge is that you can afford more today. You can afford more with the lower rates. So that has pushed up values. But let's say the values go down, right? If you could afford the mortgage when the values were high, even if the value goes down, you should still be able to afford the mortgage as long as your income has stayed the same. And typically most people, when they have a job, if they're salaried, their job, as long as it's stable. The biggest issue to the market is going to be employment. If employment basically gets hit and we lose a lot of jobs, that's going to be where you're going to see a lot of foreclosures. But as long as jobs stay stable, even if the values go up or down, the person that took out a 30-year fixed mortgage 2 years ago is still going to be able to afford their 30-year fixed mortgage today. So, and there's a lot of less products, like aggressive products. A lot of banks don't do ARM loans. There's really no products with prepayment penalties anymore. So a lot of people are really focused on 30-year fixed mortgages. During the COVID, a lot of people went to 15-year fix because rates dropped so low. They were like, man, on a 15-year fix was equivalent to what I was paying on a 30-year. So now they're paying off their loans faster. So people are actually building equity a lot faster today too. So even though values go down, people still have equity. So I don't see the market having as much of a correction as people may fear may happen because of the way low interest rates have driven up prices. It's because affordability-wise, people can still afford their mortgages. And there really hasn't been a lot of these crazy products that there was 13 years ago, and the market hasn't really asked for it. So if that happens, I would sell everything because I would think there's be another crash again.
Thank you.
Yeah, of course. Any other questions?
Do you think if inflation is, if they start raising rates and it's going to be that the rates tend higher, which you brought that out earlier, is it going to be, do you see that actually affecting the buying spree that you're seeing right now, or do you think that'll have much of an effect? And I know every market is different, and probably even in Hawaii, each of the islands have different markets, but like, is that going to affect purchases made in Kaka'ako, or is it going to slow that down a little bit?
Oh, absolutely. Absolutely. If you think about qualifying at a 2.5% interest rate versus qualifying at 4%, you lose a lot of buying power. So definitely it's going to slow down the market, I believe. And it's going to make it tougher for a lot of people to try and afford what they may really want to buy. However, I'm not really having too much problems getting people into homes and qualifying them, even when the rates have moved up. It hasn't moved up significantly, but if we starts getting into the 4s and 5s, it's going to really make a huge impact. I think prices for real estate is going to stabilize. I don't think prices are going to tank. But I do think if rates continue to move up, it's really going to start to impact. I mean, when rates were really low, like if you're selling a house for, let's say, 800,000, which sounds like a lot, with the rates of low, you might have 10 people that can afford it. But if rates go to 4% now, from 10 people that could afford it, now you may only have 5. So having less buyers that can afford your property will definitely impact the market valuations overall. Good question.
How does the appraisals affect your decision? And if the appraisal is higher than the price that the seller is willing to sell it for, does that make it a slam dunk, or is that not that big of a factor?
Yeah, so there's 4 things that lenders look for any transaction: credit, capacity, the ability to have stable income, cash, and 4th is collateral, the property. All right, so if you're putting down, let's say 20% and the appraisal comes in short, you may have to bring in more cash, or you may have to add mortgage insurance to your transaction if you cannot renegotiate with the seller. Now, if the appraisal comes in higher, that's great, but we still don't factor that you can decrease your down payment. We use the lesser of the sales price or the appraised value. So whichever is lower is what we use for financing when you're doing a purchase. Now, the higher the appraised value, it helps because it means you have more equity in the property. However, the property itself is also analyzed. So even if, let's say, the property appraises at $1 million, but the appraiser notates that the roof is leaking, or there's stains on the ceiling, or there's chipped paint, or let's say there's cracked windows, that can impact the actual ability to close that loan. Or let's say there's termite issues where, like, the house, there's active termites and it needs to get tented, or maybe say one of the main beams are significantly impacted by termites. We may not actually provide financing for that property. So appraisals are important, but there's other factors with the collateral as well.
You call the management company in a condo circumstance and ask that property manager, one of the big property managers, what do you think of this property? Is there am I not getting a straight story?
So I think the challenges with, like, so for condos, like I live in a condo, I live in Poalani in Kaka'ako, love the building, great building, if anyone wants to move in here. But some condos, they have challenges. Like, for example, there's a building called Hokolua. And the reason why I know about this building is because my parents lived there. They have about 500 units. All the roofs were replaced, and the roof material was defective, and they basically started growing roots on the roof. So like there's like weeds growing on the roof, and some of them are leaking. So like for us, we won't even lend in that project. Now, that kind of issues does occur from time to time, but most buildings are acceptable. But if you called the property manager and asked about the building, they're not going to really share too much details. Really, you're going to get details from reviewing the condo documents, which if you buy a property, you're going to be able to see all that. You can review that. The seller should have to provide a disclosure to explain everything. And usually the listing agent and your buyer's agent should be able to get you a lot of information about the building itself. But it's hard to ask a property manager. They probably won't share too much information with you besides just what they have on file. That's all.
Is it illegal or unethical for the project manager, for whatever reason, decides to badmouth the condo?
Yeah, they'll get fired. I mean, like if you are working for the condo and then you basically badmouth them, if they find out, they'll fire you. And I'm pretty sure there's a code of ethics that they basically would get. That would be a big issue for sure.
Thank you.
So Manny, what's the best way to try and find a house? I mean, they have the multi-listing, but do people find it on the internet, or how do people find the house specifically if they have to? You have to be in there within 10 days to find a property.
Well, the first thing to do, I tell everyone, is get pre-approved for financing. Make sure that your financing is in order, because if you don't get pre-approved and you basically start home searching, if you really find a property that you like, let's say you went out today and you looked at a home, you go, I love this house, but you're not pre-approved. You got to scramble to get yourself pre-approved, because a seller is not going to want to get an offer without a pre-approval letter unless you're paying in cash. Now, the great thing about the internet, there is a ton of access of information on there. That's the way to start. A lot of people use Zillow, Redfin, but having a great realtor to help you is always very valuable. Some of the realtors that are very well known in Hawaii have access to other agents that will tell them there's new properties coming on the market to try and get your foot in the door first. So having a good agent is always something that I recommend. It's hard. There's a lot of ways to find properties. You can actually just go knock on doors if you really want to and try and see if anyone's interested in selling their home. But I would recommend online and finding a really good agent that knows the market and that's actually reputable in the marketplace, because that can add a lot of value if you're trying to buy a home.
Also, back in the 80s when the white Cadillac was driving around Hawaii, and that Japanese buyer was stopping and knocking on doors whether or not you wanted to sell your house, right? You remember that?
So that was Genshiro Kawamoto.
Yeah, right.
And I think he owned about like 500 homes here in Hawaii. When I bought my house in 2003, in Hawaii Kai, he unloaded about 100 properties. I wish I bought every single one of them. It was $250,000 on average for a single family home in Hawaii Kai. Man, I wish I bought every single one.
When was that?
In 2002, 2003.
Wow. That would have been a bargain.
Would have been a major bargain.
I think we had time for one more question because we want to close the meeting at 1 o'clock sharp today.
I'm okay, but there's a question in the chat. It says, from Aaron, I have heard that lenders were not lending on a project with an active construction defect or litigation. Is this generally true as a rule? The answer is it depends. So what I mean by that is if the property has a construction defect, there means there's going to be potentially like a special assessment, or there's like a special assessment, like for example, like the one I told you about, the roofing issue. That one could cost a lot of money to fix. So each unit may have to pay $10,000 to $20,000 a piece to go and get their roofs fixed. We potentially will lend on it depending on your situation. Like if you're a customer of American Savings Bank and has a lot of money with us, you can get a financing for a lot of different things. If you don't have any relationship with us, we may not be able to assist. Like I have a client that's trying to buy something, and she's a good friend of mine, and she has a lot of money with First Hawaiian. I told her to go back to First Hawaiian because I said, if you tell them that you're going to pull out your money from First Hawaiian, they will probably do the financing for you. So a lot of it just depends. But if there's issues in a project with like litigation or construction defects, a lot of mainland banks like Wells Fargo or Chase, they don't care how strong you are in the Hawaii market. They won't do the loan for you if there's issues with the project. Good question.
Mac, last quick
Let me
question.
ask, okay. What are the interest rates? Like ours are 3% in the US, I guess, in like other first world countries and then third world countries are.
Well,
That's it.
I mean, I have some info. So like in Japan, rates are still like, I believe, between 0 and 1%.
Yeah.
And in Japan, they were doing 50-year mortgages. But for those, even though the rate's at 0%, like I had a friend that lives in Japan, had a 15-year fix at 0%. But to get that rate, he had to pay 5 points. He had to pay 5% up front to secure that rate. But in like Turkey, for example, rates are in the 13s to 15%. So every single market is different. Every market has different financing requirements. Like for example, I think Canada doesn't do 30-year fix. They only do ARM loans. So it just depends. But I mean, Hawaii overall, 30-year fix is kind of like the predominant mortgage for sure.
Thank you.
So how does the bank make money on a 0% loan product?
So for the one in Japan, like I said, they paid 5% up front.
And
So,
that's the only place they're going to make money?
Yeah, I mean, that's for his loan, that's the only way I can see it. But I think at one point they had negative rates. So they were actually, to hold money in the bank, they were actually charging you money, which seems kind of ridiculous.
So I hate that. They're stripping your equity, basically. Yeah. And that was for some of these loans in the 2006.
Yep.
Yeah.
Well, thank you very much. I'm glad we're doing this. Sam, do we have a certificate at this stage?
Wait, let me
actually,
ask.
I don't, but I will give it to him.
But thank you guys for letting me come and speak to you guys today. If you guys have any questions, I'll send the deck over to Sam, and then you guys can let me know if you guys have any questions. All right. Thank you, guys.
Okay, thank you, Manny. Really appreciate a lot of good information. So I'll talk to you later and get the certificate over to you. I'm going to stop the recording now.
Engineers and architects of Hawaii welcome your comments on this program and any of our recent programs. We encourage your direct participation in this community outreach. So please email us your comments and ideas at eahawaii@gmail.com. Each month, a $50 award will be given for a selected comment or idea on current or past programs. Mahalo.